The comments from James Bullard at the St. Louis Fed had immediate market effects. We saw them in interest rates. We saw them in certain commodity prices and the equity markets. Is this a game changer, or is he just basically telling us what we already know, that this is going to be higher for longer?
Well, I think he's telling us what we already know, but some of us don't want to hear, and that is that the Fed is committed to getting inflation under control. Historically, that has meant raising rates up to the level of inflation. Now, we don't think that that's going to be the case this time, but we have to be respectful of what it's taken in the past.
So, Mark, with that in mind, we're showing a panel worth of economic data, a lot of it inflation related, CPIs, PPIs, whatnot. There's maybe a growing consensus. It's certainly not consensus yet, a growing one, that inflation may have peaked or be in the process of peaking. If that is the case, what does that then mean for the prospects for the economy going forward? Are we doomed to a recession?
Well, it has gotten more difficult to ensure a soft landing. I mean, that's clear for a couple of reasons. I think the resilience of the economy, on the one hand, is very welcome, but it's also kind of made the Federal Reserve realize that they may have to keep tightening for longer, and that could ultimately result in a bit of a deeper recession. I think, what people need to realize is that coming off the peak of inflation is good, and that could lead to, something like a Santa Claus rally. But what is the real open question, and one of the reasons we have concerns about next year, is that coming off the peak doesn't mean that you're coming back to target. And what nobody knows is, does inflation get stuck along the way, say in the 4% range or something like that, requiring the Fed to do more? And I think that's reflected, that kind of thinking is reflected in some of what we're hearing from the Fed.
Mark, it sure sounds like you're a little bit more, cautious. I guess we could use the cliche, cautiously optimistic. With that in mind, do you feel as though the best places to be right now are in some of those places in the equity markets that are perhaps less prone to economic cycles, more defensive in nature?
Absolutely. First I would say that one of the sectors we like is energy and value. And energy, has been a tremendous performer this year. So we're not saying you have to exit the equity markets, but we have a focus on value over growth. Value, we've found, has outperformed whenever inflation is higher than 3%, and that's certainly the case today. And then we're also looking at things like consumer staples and healthcare, which have been strong performing sectors. And we think that being a little more defensive in your equity allocation makes sense, as we believe that earnings expectations and the earnings in, say, the first and second quarter may come lower as some of this economic activity slows because the Fed's rate hikes start to bite.
Now, Mark, before we let you go, one of the other places that we're looking at a lot more these days, for obvious reasons, is the bond market. Treasury prices and interest rates have been a huge focus here. Right now, it looked pretty good if you had bought 10-year Treasury notes with a yield of 4.2%, seeing as the yield is now 3.8 right now. Do we look more towards some of these yield plays? Do we look towards investment-grade corporates or treasuries with yields at 4% or above as attractive?
We think so. The good news for going into next year is that you can get a lot more income from high quality bonds. And so that's certainly a part of our portfolios now. I think investors, our clients, are scrambling a little bit to get more familiar with actually earning income on bonds, high quality bonds again. We would also look to investment grade as well here, because we think that there's some opportunities there.